Guys, so today we'll be looking at a practice question for the topic of partnership changes. This topic is from the syllabus of our A2 exams, and we have taken the reference data from a past paper question that is from June 25 paper 32. So let's read the question and try to complete the requirements over here. So over here it says that Ahmed and Betty are in partnership for many years, but they did not have a partnership agreement. So, in case if the partners don't have an agreement, we simply assume that the partners are sharing their profits and losses in the ratio of 50-50 or 1:1. Alright. Then further it says that the partnership statement of financial position at 31st December 2024 was as follows. So we have a statement of financial position at the end of the year, and then there are some additional information as well. Over here it says that Betty retired on 1st January 2025 and Chandra was admitted as a partner on the same date. So there are two structural changes happening at the same time. A partner, Betty, is retiring from the partnership, and at the same time a new partner is joining the firm whose name is Chandra. Further it says that Ahmed and Chandra agreed to share profits and losses in the ratio of 3:2. So the new partners will be sharing the profits and losses in a different ratio from the previous one. So now the ratio would be 3:2. And further it says that the following arrangements had also been agreed by all of them. So all of the partners agreed on the data that is provided below. Over here it says that assets on 31st December 2024 were revalued as follows. So three of the assets over here we can see they are being revalued. Alright. Then further it says that goodwill at 31st December 2024 means at the end of the financial year was valued at $90,000, and further it says that no goodwill account is to be maintained in the books of the partnership business. This simply means that we won't be preparing a separate account, or we won't be recognizing goodwill on permanent basis in our books. And of course it makes sense over here because the goodwill that is mentioned over here is the inherent goodwill. This is not the purchased goodwill. So inherent goodwill is not recorded in our financial records. Alright. Further it says that the amount owed to Betty was settled in full on 1st January 2025. So the day on which Betty is retiring, all the amounts that the partnership owes to her will be settled on that date. Alright. And further it says that in point number 4 that Chandra introduced cash to pay for her share of goodwill. So Chandra is paying for a share of her goodwill. Alright. Then it says that contribute capital so that the capital account balances at 1st January 2025 are in the profit sharing ratio. So she mean over here what the examiner means that the ratio of capital would be equal to the ratio of the profit and losses sharing ratio. So the profit and losses sharing ratio over here is 3:2. So the capital balances should be in this ratio as well. Alright. Further it also says that Chandra has introduced cash to make a loan of $40,000 to the partnership. Alright. And then it says that Ahmed introduced cash to pay off his current account debit balance. Okay, so Ahmed has a debit balance on his current account, so he has introduced some cash to settle this debit balance. Okay, so we won't be solving the requirements that were asked by the examiner. We are simply taking a refresher of this topic. So I have decided to prepare the capital accounts of all the partners over here so that we can see how the goodwill works over here, how the revaluation of the assets work over here, and how do we retire a partner and how do we admit a partner. All of the things we can see at the same time through the capital account. So here I have prepared a format for the capital account. Let's try to make it. So we have the name of the partners, we have Ahmed, we have Betty, and we have Chandra. Same goes on the other side as well. So we have Ahmed, we have Betty, and we have Chandra. So this is the credit side and the left one is the debit side. Okay, so at the start of the year, there were only two partners, and who were them? There were Ahmed and Betty. So we will be starting with their balances first of all. So their opening balances will be, of course, they'll be recorded on the credit side. So we have balance brought down, or the opening balance. So for Ahmed there is $250,000, and for Betty it is $180,000. Chandra has not joined the partnership, so we won't be recording any balance over here. Further, let's start with the data that is provided over here. So the first thing that we are told over here is that some of the assets were revalued. So equipment was revalued, it was of 185,000 and now it is of 161,000. So it is being revalued downwards, and by how much? Let's calculate that. 185 minus 161, so it is being revalued downwards by $24,000. Then about the motor vehicles, the vehicles are also being revalued downwards, so again by $31,000. And then further, the inventory is being revalued upwards over here. So by how much? The inventory is being revalued upwards by 105 minus 82,000. So it is a total of 23,000. So if we are to calculate the total impact of the revaluation, so there is negative 24,000, negative 31,000 and $23,000. So the total should come up to 24 minus 31 plus 23. So the total of loss on revaluation is of 32,000. This is the loss on revaluation. Let's also discuss the journal entry for this. So it would simply be that we will be recording a loss on revaluation. This should be debited, and our assets, the non-current assets and the current assets, let's just say assets over here, so they are being credited. That means that they are losing their value. We are reducing their value by $32,000. All right. Now this loss on revaluation, the impact of this should transfer to the existing partners. The reason for that is we always give the benefit or transfer the cost of the revaluation to the existing partners. And in case if it's the benefit, so the upcoming partner will be paying the amount of that benefit. And if it's a loss on revaluation, so we can say that the existing partners will be compensating the new partner for the loss on revaluations. So over here there are some losses, and these losses should be transferred to the existing partners. All right, let's transfer them. So they will be debited in the capital account. Of course, they are reducing the investment, or they are reducing the capital balances of the partner over here. And so let's record them over here. Loss on revaluation, and the total of the losses was 32,000, and again both the partners were sharing the profits and losses equally. So the loss on revaluation should also be transferred equally to both the partners. So $16,000 should be debited to both partners over here. Okay, then moving on, there is some discussion about goodwill as well. So it says that on 31st December, goodwill was valued at $90,000, and no goodwill account is to be maintained in the books of partnership. So what we simply do over here is that we introduce the goodwill according to the old partnership's profit and losses sharing ratio between the old partners, and when we have to remove the goodwill, we remove it via the new profit and loss sharing ratio and according to the ratio of the new partners. So we have the total goodwill of $90,000. Let's introduce this goodwill first. So this goodwill would be credited to the capital accounts. So $45,000 to Ahmed and $45,000 to Betty. Alright. Then we have to remove this goodwill as well. Okay, so let's do that as well over here. So in order to remove the goodwill, we will be debiting the accounts, and the goodwill would be removed in accordance with the new partners and according with the new profit and losses sharing ratio. So the new partners are Ahmed and Chandra. So what we'll do over here is that you will simply take $90,000 for Ahmed. We will multiply it with 3 and divide it with 5. So this amount should come up to $54,000, and for Chandra it should be the remaining $36,000. Alright. Moving on, it says that the amount owed to Betty was settled in full on 1st January 2025. So all the amount that are owed to Betty, she will be receiving it on 1st January. So let's see if there are some other amounts that are also owed to Betty. So as we can look at in the statement of financial position, Betty have a positive balance, a credit balance of 5,500 in her current account. So again, this is also the balance that the partnership owes to her. So we will be transferring this balance to the capital account. So what will happen is that the current account would be debited and the capital account would be credited over here. So here's the current account, and only the balance of Betty will be transferring over here. So we will be crediting 5,500 over here. Ahmed is of course, he is still the partner, so no balance of his would be transferred over here. Alright. There is also a loan from Betty. So the loan is of $15,000. So we can also transfer that loan to the capital account as well. So we can get a total sum of how much the partnership actually owes to Betty. So the journal entry for this would simply be that the liability on the business would be reducing. So we will debit the loan from Betty by $15,000, and this balance is being transferred to her to her capital account. So of course the balance of her capital account would increase. So her capital account would be credited. So let's add this balance on the credit side of her account. You simply write down loan and $15,000. I guess we are done with all of the adjustments regarding to the retirement of Betty over here, and I don't think any other adjustment that pertains to the capital account are remaining. So let's try to close these accounts now. So let's make the calculations for Betty first. So the total on credit side is 180 plus 45 plus 5,500 and 15,000. The total comes up to 245,500. The credit side should also be equal. So the total should be 245,500 over here as well. And over here now Betty's, of course, she is retiring, so there won't be any balance carried down on her side. All the balances that she is owed from the partnership will be paying her on 1st January. So let's say that the partnership will be paying her from the bank account. So after reducing the impact of loss on revaluation, the remaining amount she will be receiving through the bank account. And for her balance carried down, there won't be any balance left over here. Alright, for Ahmed, it says that the credit side has 250,000 and 45,000, so the total should come up to $295,000, and the credit side should also be equals to this. So the closing balance should be equals to $225,000. Okay, to calculate the balance of Chandra, we first need to know how much capital has Chandra introduced. And over here in point number 4, it says that Chandra introduced cash to contribute capital so that capital account balances on 1st January are in the profit sharing ratio. So the capital account balances should be in the ratio of 3:2. So through this ratio we can find out the capital that Chandra has actually introduced. So on 1st January 2025, Ahmed has a capital of $225,000. So over here we can say that this $225,000 is actually equals to the 3/5 or the 60th percent of the total capital. This means that the remaining capital, the 40%, the 2/5 of the ratio should belong to Chandra now. So we can find out the missing figure through cross multiplication over here. And it should come up to 225,000 multiplied by 40 and divided by 60. So the balance of capital comes up to a total of $150,000. So this $150,000 of capital is actually introduced by Chandra. So we will simply record it. Let's say this amount was received in our bank account and this $150,000 was paid by Chandra. And so 150,000 should be recorded over here, and in order to calculate the balance carried down now, this 150,000 we should be reducing with the amount of goodwill over here. So the balance should come up to $114,000 now. So here we are done with the whole capital account. I hope everything is clear now. So let's just look at the whole workings over here. So what happened is that Betty, she is retiring. So we brought all of her balances into the capital account. The balance of her original investment, that was the balance brought down. The amount of goodwill that actually belongs to her, the goodwill, the benefit of goodwill that she should be receiving. So the goodwill was 90,000 and half of the goodwill's benefit should be received by Betty. So $45,000 were credited over here. Then the balance of her current account was also brought over here, and she had a loan. She had provided a loan to the partnership, so we have brought that loan over here as well. And then anything that needs to be deducted from the retiring partner, that was the loss on revaluation. So we deducted that loss on revaluation from her account, and the remaining balance was transferred to her via the partnership's bank account. For the new partner, simply what we do over here is that we credit the amount of investment he is bringing into the business, and from that investment we do deduct the amount of goodwill that he is actually paying to the existing partners. So he agreed to pay $36,000 to the existing partners. So the existing partner was actually Ahmed over here, so he will be receiving the part of the goodwill over here, and all the adjustments are simply recorded over here. I hope everything is clear now and you were able to revise the topic of partnerships structural changes. Thank you.